Okay, folks, welcome to Volume 7 in the continuing series of the Market Maker Collection. We're going to be focusing on the ICT cell model here, and it's going to be pretty much a mirror image of everything that was described in the previous installment, Volume 6, where we discussed the ICT buy model. And you're going to see that while many of you have really made it much harder for a concept to be absorbed than it needed to be, there is an overlapping between both the sell and buy model. And it's because the pattern is a fractal. And fractals move inside one another, they inhabit one another, they reside in one another. And where one market profile ends, another one begins. And even where that transition takes place in a larger scope of that section of price action, you actually see, in other words, inside of a buy model, there may be a sell and a buy model in smaller time frames. Okay, but overall, between those three overall fractal patterns, they make up the larger one. So it's important that you understand that we're really basing this entire premise on the inherent nature for price action to be fractal in in a generic term. But many times it's been tossed about by mentors and even myself. I'm guilty of this as well. That we rather mention it glibly that fractals are easy to see. Well, without really breaking down a market or a sample set of price action, it's really hard for one to come away with an understanding of what is deemed a fractal. Um, every single time I've come in contact with a mentor or an author or someone that refers to fractals in price action, I'm I'm quick to ask them, what is a fractal to you? I ask this you know of people that will ask me in an email, is this a fractal that you would go long in? Well, I ask them all the time, what is a fractal to you? Because just because there is a label applied to it by someone else doesn't necessarily mean that that is the same thing that we all see. Okay, um, and I'll give you an example of that. If we look at a head and shoulders pattern, classic price action. Okay, a head and shoulders pattern in early stages of trading may not be so clear to one another. Okay, we could all look at a chart. If we all simply went back to the very beginning day of us looking at a price chart and we looked at a head and shoulders price pattern, if every one of us had the same example placed in front of us, it goes without saying not all of us would have identified that as a head and shoulders, even if we were conceptually shared the general idea what a head and shoulders pattern is. And it's simply because we haven't warmed up to the the discovery of what it looks like and understanding what it looks like and how does it become evident in price action. Because without the understanding of how that takes place, talking about these things conceptually, and whether it be you know broad brushed and vague as we have here in a very conceptualized manner in this ideal depiction as I see a fractal, um, it won't make any sense to us if we don't have a framework to build upon. And that's really what we're doing here in volume 6 and volume 7, to give you an idea on how I see price action, how I view price action. Because no matter what you uh, look at the market in, whether it be 5 minute, 1 minute, hourly, weekly, monthly, doesn't matter the the time frame at which you're looking at price. It's the manner at which you're looking at price. Okay, because if we can uniquely remove all of the distractions and just get to the core of what is price action doing right now based on what it has done most recently, and if we can have a higher time frame premise in addition to that, it moves along the odds of our being successful in an exponential fashion. So without all that you know preamble, let's get right into this one. We look at the buy model, okay, and I'm assuming you probably just watched that video. So if you're looking at this, you'll see this is pretty much the mirror image of what we disclosed in the buy model. The initial consolidation, okay, um, this is where orders are accumulated And I know most of you will probably assume that this should say distribution to accumulation, and that's not the case. Okay, the markets are always predisposed to be um, sellers. Okay, so they're going to sell, 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 and by selling, they are accumulating. And I know that's hard for some of you to grasp, but you got to look at it from an institutional side. You're accumulating orders by being the storehouse or the seller. Okay, none of us can buy British pounds without their yes being a supply house or okay or a central bank that um, prints that particular currency. They have to accumulate always. Now, by their accumulation, the way they will offset their risk, okay, or reduce their risk, manage their risk, or profit, they will distribute. Okay, so it's important to understand that the central banks are in business to yes provide liquidity, but they're also a business. They're not just simply there to give everyone free opportunities to make money. Okay, so the initial consolidation in here is an accumulation phase. The market will move into the run to resistance, okay, and then the next stage is the smart money reversal. Okay, so any longs that they would have accumulated in here or hedged on a larger time frame position, maybe this is um, a short bear market, and they would have accumulated some long positions to hedge during a anticipated move higher that would set up a longer term additional selling point where they could get more short positions in the marketplace for their longer term trade lower. So they could accumulate longs in here to do what? To hedge their short position, okay? And they'll reaccumulate in here and buy more, and it'll run to a level of resistance, and then they will distribute what they had hedged back here, okay? And by going short in here, as the market starts to break down, the next level is the distribution for the low risk sell. This is where it's clearly seen many times by a lot of guys in my camp where they'll see the optimal trade entry. Okay, market structure will break up here, then they can classically see the ICT optimal trade entry, 62 to 79% retracement level, or what we dub classically the 70.5 fib retracement level into a previous order block, and then they would get short. The next stage is either a redistribution, okay, or in other words, an increase of more selling orders or short orders, or like we had in the previous teaching about the ICT buy model, this stage here can be a reaccumulation point. Okay, in other words, this could be a buy, a retracement here just to reaccumulate more longs that they had accumulate here or in here. Okay, so in this area here, we could see the resumption of a longer term uh, bull trend, okay, or this could be redistribution. And this is where you're going to get hung up if you do not have a higher time frame premise. Yes, you can trade without a premise. Yes, you can trade without a bias. But the problem is you're going to get hung up here all the time. This is going to be the trap for those individuals that simply don't want to trade with a bias. Okay, they're going to get banged around in the marketplace right here because they're going to be looking for additional selling short positions, and it won't happen. What will happen is they'll continue to move higher and trade, you know, eventually taking out this high here. But then we're going to stick with the classic definition of a sell model here. The next stage from this redistribution or new area to go short, they would eventually move down into the distribution level. Because they accumulated here and they're distributing here. They're distributing here as well. What are they distributing here? What they went long here. What are they distributing here? The long-term positions that they accumulated on a higher time frame short position that we can't see in this graphic depiction. Say this is a downtrend. This would be a classic selling in a down market, selling it up here. Well, if they sold it here, they can distribute those shorts or cover them basically here. Or if it's in again like a higher time frame bear trend, we could assume that they had been long much farther back in time, and they would be covering here after they neutralize the orders that would be resting below here. Okay, so we have a couple different ways to use this price pattern, just like we discussed in the buy model. You can view the market in several stages and different durations, whether it be, for instance, let's just look at this in form of, say this is an hourly chart. Okay, we could look at being a buyer in here, okay, with the anticipation that we're going to see a move here, moving up into a level of resistance of some sort. Okay, and that right there could be what you would use just to nail down a 30 pip trade. And I've taught many times that you can build a career on 30 pips per week if it's done consistently, and you optimize your equity and how you're allocating that money, and managing the risk. If you're consistently doing that exponentially, your money can grow to, millions theoretically, just by taking 30 pips every single week. Problem is you're not going to stop at 30 pips, but nonetheless, if you take these types of surgical precision entry points from here to here, you'll know that yes, you could be in a mood that continuously moves higher. But as you begin to understand how we work within fractals and price action, you'll learn by every single trade you take. Hopefully, if you keep in detailed notes about why you went into the trade, take screenshots of what it looked like before you went into the trade and what it looked like afterwards. Okay, and spend a lot of time studying that. The losers you should spend time with, yes, but don't beat yourself up about it. Because if you do that, what you're going to do is you're going to build a toxic view of your personal approach to trading, and you'll keep reaffirming to yourself that you're a loser. Your ability to make money is absent, okay, and you're void of understanding, and therefore you're wasting your time. Okay, the way we use the losses in the marketplace is to frame it on what we understand, basically in the context of what we're sharing here. How did it meet this model? What did we do in the trade that didn't line up with our understanding of how price moves in fractals? And by doing that, what will happen is by default, over and over and over again, you'll see your results glean more understanding. And that's why it's important that you keep your risk very, very, very small, less than 1%, less than a half a percent when you're first starting, because it's not about making money. It's about consistently finding an approach that fits your psyche and using these concepts. Because if you blend the two together, not all of us are going to use these concepts exactly the same way. They're not. And when you see later on in this video the examples of the fractal patterns that are available, you're going to see how all of us will be able to see the same price chart, same sample size, and see different trades within that same context of price action. That little block of area of price action that we're going to look at later on is going to be a plethora of opportunities using both a buy and sell model, and neither one being wrong. That's the paradox of fractals, because you'll see a bullish buy model, and I could see a sell model, and either of us, okay, are liable to make a profit. But yet, if we were to contrast one another's analysis in the beginning, we could scare one another out of the trade if we listened to the other person. You follow what I'm saying? So that's why it's important not to bounce ideas off of what you're intending to do with your trade. You don't care what anyone else is doing. Okay, you have to have an individualized mindset about trading, and by giving yourself a framework like this, okay, and this may not work for you. I'll be honest. I'm cognizant of that. This may not make any sense to you, but I think if you give it a fair shot and spend a little bit of time with it, it will give you a solid foundation to, if not stick to for the duration of your career as a trader, or at least lead you in a direction where a greater understanding will be needed in studying certain things. And like I said, it'll help you along by some measurable uh, amount. I can't obviously say it's going to be equal to everyone, okay, but for those that have used or tried to use the model, these two videos I believe will absolutely open up and unlock the understanding that you should have using them. So let's go into a little bit more detail. Now again, we have the initial consolidation over here. Okay, and how do we identify when a sell model is forming? Well, nonetheless, it's important that you have to go back and understand that these these sell patterns are really easy to see in bear trends. Okay, when you're in a downtrend, the market maker sell model is going to be very, very clear. It's easy to see. Okay, but I'm going to show you in this video how you can see the sell models in bullish conditions. And that's going to be like, what? What are you talking about? And you'll see it. And once I show it to you, you'll say, well, yeah, there it is. And by seeing it and studying this video, don't just watch this video once, okay? Because this video is actually going to be better than we showed in terms of the concepts. The things that we discussed in volume 6 will help you blend the two together. And trust me, you'll never look at price action the same after these two videos. I'm not saying these are two most important videos of the series, but these two particular videos will unlock your vision of price action. Okay, and you'll never look at the markets the same way. Okay, and it's absolutely be empowered by having this understanding. But assuming for a moment that we're not trading with a bias, okay, we can identify a support level, or what we understand from previous teachings of mine, an order block, okay, which is necessary. So when we come into an area where we anticipate a level of support, okay, and support can be horizontal uh, support and resistance based on an old high, an old low, okay, or it could be a bullish order block, okay, and the higher time frame is ideal, okay, and that means the monthly, weekly, daily, and 4 hour, and no less than a 1 hour. Okay, because if we trade with fractal patterns like this, less than a 1 hour, many times the opportunity to make pips are reduced so low. And I'm going to speak from my own premise of looking for trades. I don't like taking 10 pip opportunity trades. Can you build a career on it? Absolutely. To me, I just don't think it's worth it. Now, some may argue that, that's their cup of tea. And now I'm not going to try to discourage you from doing that, okay? But I'm just saying that I like to see these patterns form on an hourly basis to give me the framework of what I'm looking for. Nothing less than an hour. Unless I'm really, really ultra intraday trading and scalping, then I'll look for it on like a 15-minute chart. But you can use it still nonetheless in the overall context of price action to map out where the order should go from point A to point B to point C, okay, as we're going to discuss here. So at a support level or an ICT bullish order block, if we see consolidation and a rejection of that area moving up into an area of anticipated resistance, okay, and again, that resistance come in the form of horizontal support and resistance, an old low, an old high, and or a bearish ICT order block. Okay, and if you don't know what an ICT order block is, you don't have any business watching this video series. You need to go back to the Sniper series and Precision Trading Concepts. Once we come into an area of resistance and or bearish order block, okay, we would anticipate a breakdown of the market structure as we have here graphically described, eventually coming back down, neutralizing the original order here. Because when we see a level of support, assuming, okay, for a moment, sticking with the idea that this is a bounce in a bear market, if we come down to a higher level time frame order block or weekly support level or daily support level, we have to anticipate the likelihood, even though the trend may continue going lower at a later time, the likelihood at this higher time frame support level, especially if it's a solid order block, price has an opportunity to do what? Bounce. Okay, so even though we see the market move up and find old resistance turn support here and continuation move higher, when we enter into another level of clear resistance and or bearish order blocks, okay, we have to anticipate what occurring, keeping true to form, because we don't like to try to find or pick rather the low or the bottom in bear markets. We would be more inclined to be sellers up here because we would be looking for this model to unfold. Okay, so as the market starts to break down at a known area of resistance in an existing downtrend, we could look for very easy optimal trade entries to sell short at. Okay, and now let's take a step back. If this is what it would look like on a hourly chart, okay, change it for a moment and say now we're on that daily chart and we had bounced for several days, that it's moved higher and higher and higher, okay, and it starts to move lower. We can now, in this area where we anticipate the market to start moving lower, you can utilize this area right in here on a daily chart. Okay, if this pattern's occurring on a daily or a 4 hour, when we enter this area in here, what do you think you could do with that in terms of day trading? Well, in here, it would be very easy to see the opening, a rally up or a Judas swing to make the high of the day, and position yourself for the move lower, ultimately aiming for the neutralization of the original consolidation and or eventually breaching this support level. Because again, our belief is that long-term macro trends continue more times than they reverse. Okay, so yes, eventually all trends are going to reverse, and there's going to be bounces along those trends, but ultimately, in a downtrend, what we like to see is resistance supported or affirmed. In other words, or respected. So in other words, resistance is confirmed by seeing rejection lower in price action, and we want to see support levels breached. That's what we that's what we want to see in downtrends. And the reverse is said, obviously, for bull markets. We want to see support levels confirmed or affirmed, okay, and see bounces higher in price, and we want to see resistance levels breached. Okay, when we see that, we see strength in those existing trends. Assume for a moment that we are wrong and we didn't see this as the actual low in the higher time frame trend. Okay, if we see this area here, see it rally up and blow out this high here, we know that we have most likely changed tides, at least on the higher time frame or the time frame that this fractal pattern is underway. Okay, doesn't always mean that, but we have a high degree of probability that that was the case. So in other words, if we don't get down here, okay, the opportunity now shifted to a bullish stance here. So then you would see a classic, what we identify as an ICT optimal trade entry long. From here is the price swing here. We have an impulse move, a retracement, and then this would be a 62 to 79 retracement level of the swing from this high to this low, and the classic buy here. And that would be a continuation. So the sell model changes gears to selling short in a downtrend to buying. Okay, you'll be a buyer using the sell model. See what I'm saying when I'm talking about how you can use them interchangeably? There's no hard and fast rules to looking at fractals except for the fact that they exist within one another, and they can segue from what would be deemed a bullish fractal right into a bearish fractal, and vice versa. So if that doesn't make any sense to you, we're going to actually look at some examples in a little bit, and it'll make a lot more sense to you. So now, using our previous example in volume 6, okay, we're looking at the Aussie yen, same area of price action. I used a very generic area. I didn't try to pick the best of the best. I just picked a very discernible, measurable area where we could clearly see support level at around that 91 figure and 90-80 level. Okay, and let's take a closer look at what you should have seen in price. Understanding fractals. As we see here, we can clearly see and identify the original consolidation. And this is the same thing we used, or same chart rather, we used for the buy model in volume 6. We had the consolidation here, it drops down, makes the high here, I'm sorry, the low, and reaccumulation. And this is the area where we move into the smart money reversal. Well, I'm sorry, this is the smart money reversal, and this is where we distribute what we accumulated over here on the buy model. Well, the same price action, okay, laid out in front of another trader, this is what they may see. And both are correct, okay? So don't read into that saying, well, if he sees a buy model and I'm seeing a sell model, we're not learning the same way. Yes, you certainly are, but you're just thinking individually. That's the beauty of trading. All of us are doing something different. Some of us are doing things similarly, but none of us are getting the same results in either capacity, whether we're looking at the market bullishly or bearishly. Okay? All of us have to identify those unique opportunities that we are willing to take the risk upon. Okay? So I'm giving you the tools to work within and find the opportunities that you are willing to put your risk on. Okay? I'm giving you the framework, if you will. If you understand these things, you'll have a whole lifetime of opportunities laid before you every single day. It doesn't matter what asset class either. But the original concept that we discussed is the initial consolidation, the run towards resistance, smart money reversal, redistribution, the low risk sell, and then we have a redistribution or reaccumulation. Okay, and we're going to assume for a moment that we're in a bullish area, or we are not in a bear market. And assuming that, um, there will be traders that would look at this pattern and they may see this and say, okay, it's going to come down and clear out this level here and anticipate something down here in a lower form of a price swing lower. But let's actually go over to the charts and look at this in a different context, but you're still using the fractal pattern, uh, the sell model. Okay, folks, we're looking at the Aussie yen. This is an hourly chart. This is basically the same sample set of price action we used in Market Maker 6 when we disclosed the buy model. Now we're going to talk about the sell model, but we're also going to pull in examples of using the buy model in conjunction with the sell model interchangeably. Okay, so you can kind of use both patterns to still find trades. I identified the 91 big figure and 90-80 levels as we talked about in volume 6. And I wanted you to take a look at price action here. And where do you see the ICT sell model? And I'll give you a hint. There's lots of them. We have original consolidation over here, right in here, consolidating on this 91 big figure. And we're going to identify that as soon as I can get my we have the original consolidation in here. Okay. We have the reaccumulation. We have the smart money reversal. We have the low risk sell. Redistribution. Ultimately coming down to clear. The original consolidation that began the market maker sell model. Right here. So we're below the consolidation right there. So we have the accumulation, reaccumulation, or run to resistance, smart money reversal,